Well, let me kick in on it. So we want to welcome to the show today Andrew Page, the founder of Strawman. I'm sure most of you are familiar with Strawman, but if you're not, it's an online community of investors that rate stocks and share their research and their tips. And I think it's been around a couple of years, but I'm sure Andrew will tell us more of the story. So welcome to QAV, Andrew Page.
Thanks, guys. Great to be here.
Where are you coming from? You're Sydney based?
I am Sydney based. We're out in the inner west.
Right. And things are going well in Sydney, I think. Still virus-free, Sydney mostly. Is that right? Unlike Adelaide today, sadly.
It's kicking around. I heard that they do testing with sewage, and that gives you a pretty accurate read that it's out there, but the reported numbers are pretty low. So hopefully it stays that way.
I wonder what else they can test via sewage.
A lot.
A little bit worried about them looking at my sewage, quite honestly.
Oh yeah, no, they can tell
what they're going to find in there. So before Strawman, we'll go back to your career a little bit, but where I want to start, Andrew, is Electric Bean. Can you tell me about Electric Bean?
This is one of those great experiences that teaches you a lot, but you hope never to repeat. So man, this is going back quite a few years now, but some friends and I thought we would open up a cafe, sort of very hip and sexy, and we thought it would be great fun, and it was a nightmare, frankly. It's a very tough business. Anyone who's run that kind of business or the restaurant hospitality business knows that it's very tough, long hours, very tiring, thin margins, hyper competitive. It was really tough. So we only had we started it from scratch. We started it, and it's a horrible name, by the way. I just want to say on the record, it wasn't my idea for the name. It's a horrible name. We started it, we ran it for about a year, and then we sold it, actually. So we broke even on our startup cost, but it was a waste of time, other than what it taught us what not to do.
What was the electric part of the bean?
That's stupid, man. I hated it. I said at the time I hated it. I'll say it again. Awful name.
I said that about QAV as a brand, but Tony, I go, no one's going to know what a QAV is, but he's the boss. So
we can change it. Electric QAV from now on.
No, stick with just QAV.
The cafe, it's interesting though, because one of the big things that Tony did early on when we were doing the show that really helped me start to understand what the hell he was talking about was he would use a cafe analogy to talk about looking at a company. And, I think a cafe is something that, even though most of us haven't had the Electric Bean experience, we kind of can grasp how a cafe works. And so, we often do use a cafe analogy when we're talking about stocks and looking at revenue and how much should you pay for it and how would you value it and capital and all that kind of stuff. So anyway, It's interesting. And you have a Bachelor of Science in Microbiology too, I believe.
Yeah.
Useful, particularly during a pandemic, I'm sure.
Well, to be honest with you, I couldn't get a job if I tried in that industry now. So I graduated in the 90s, and when I was at uni, the Human Genome Project they were doing that. It was a multinational, multi-million-dollar global effort. Now you can sequence a genome in a couple hours on a little box that sits on your desk. So that the field has moved so far beyond what I'm qualified for as to be laughable. But I know a few basic things about bacteria. Put it that way.
I'm sure that comes in handy at some point when you get kids.
Yeah.
So tell us about Strawman. Give us the pitch, and I guess tell us where it came from. I think you were at Motley Fool before Strawman. Is that right?
Yeah, Motley Fool, and then prior to that, it was a private investment club called Team Invest, and I guess just the big picture here is that there's a lot of value, as you guys would know, in getting together and talking with other investors, A, to get ideas, but B, to get sort of lean in on their experience and their insights and their wisdom. But as you probably know, it's very hard to do online. If anyone's tried to join a Facebook group, or there's another very well-known forum company in Australia that I won't mention, and there are actually some really high quality contributors, but on these places, but unfortunately they are buried underneath a mountain of noise and hype and pumping and all of the worst aspects of human nature and investing. So it was really just a desire to, without all the talking about social platforms and technology and all the hype that goes with that, I really wanted an online investment club, but one that could bring a bit of transparency and accountability to the process, so that when I'm talking to someone, I might not know their real name, but I can have a bit of insight into their track record, the companies they like, the investment thesis that backs up their viewpoints, perhaps some valuations, and it's really trying to put some structure around that. So it's actually been going probably about 3 years ago. We started building it. And I'm not a programmer. I'm not a developer. So I think I made every single mistake that there was to make in building the thing, and mistakes happen to this day, unfortunately.
Was the original name for it the Electric Strawman?
No, it wasn't. No, that's any mention of electric is blacklisted for any venture. But the idea of Strawman was really, I'm really big on the idea of having my investment ideas challenged. So I think we're all susceptible to this confirmation bias problem. So if you and I both like a particular company and we talk about it, all we're going to do is reinforce how brilliant each of us are. And it's not a very valuable process. But if I can speak to Tony, who has the polar opposite view to me, or even just a different view to me, I mean, that is super valuable. This is not about stroking ego. This is about me being either right or wrong. And if I'm wrong, one way or the other, I'm going to find out eventually. Now, I can find out by the market telling me, or I can find out by a trusted confidant telling me. And one perhaps is a bit more bruising to the ego, but it's also far less damaging to your wealth. So the idea is that we want people to share their investment insights, their ideas, their investment thesis, if you will, but we want it to be challenged. We just want it to be challenged in a very constructive way, where it doesn't devolve into an argument and end up with someone calling someone else a Nazi, as most internet debates usually devolve into that point. So that's the big picture idea. We give everyone $100,000 in play money. They can build a portfolio with that using real world prices. So you can't cheat the system here. This, for someone who has built up a good track record, has done so by picking good stocks and by managing their capital well. And that gives credibility, and that helps you determine who's perhaps worth following and perhaps who's worth listening to. Yeah, that's basically the idea.
Right. And they came from, sorry, Tony.
No, go ahead. Go ahead.
No, after you.
I forgot what I was going to say. No, I guess you spoke about investing $100,000. Are there limits on the amount you can deploy depending on how big the capital is of the company? So,
Tony, yes.
I see on Strawman a lot of people are investing in small companies. Obviously, they can't put $100,000 into each trade. Is there some kind of sophisticated, black box that stops them from doing that, or you just say that's fine?
No, there are trading rules, and this has evolved. So in the early days, we just had unlimited capital. It was more like a newsletter, like Motley Fool. There'd be buy recommendations or not, and we would just track it all in percentage terms. And then we added play money, and then we had to add rules around that. So there's a lot of rules. There's actually I'm quite proud of a lot of IP that's been built up over our time here to try and make it. There's a balance between giving people the flexibility to do what they feel is appropriate to them, but also not to game the system. So the big one is that we have a 20% rule in terms of weighting. You cannot initiate a position or add to a position such that it pushes you over a 20% weighting. So when you start off with that 100K, you can only put 20K into a position, and that cash they'll actually provide you with some cash drag there as well. So cash earns a 0% rate of return, which is pretty accurate in this low interest rate environment.
Yeah.
So that's so someone doesn't put all their money into a 1 cent stock. We've also got volume matching rules around that as well. So on the ASX, if there's $10,000 traded in a given day, well, that's all that you can buy. And that's not really something you ever have to worry about when you're dealing with the bigger stocks, but at the smaller end, it becomes very important. And just this last week, a little bit contentious actually, but just this last week, we actually had to enforce a 2 cent rule as well. So we've actually stopped people from buying shares that are less than 2 cents. There's the reason around that is that we operate on end of day closing prices only. And there were just, without getting into the minutiae of it, there were ways to game the system with people trying to buy stocks at 0.1 of a cent and flipping it the next day for 0.2 of a cent. So other than that, it is any stock. You can buy up to 20%. You must volume match with what was traded on the ASX that day. And you can only trade at the end of the day. So you can't intraday trade, which is fine. We're more of an investment platform. But that's it. Other than that, you can do whatever you like.
Does the platform take into account taxes and brokerage as well?
Yeah, no, we don't account for either brokerage or tax. We could. The reason we haven't is because it would be a consistent feature across everyone. So if we did add brokerage in, it would, I guess one argument would be it would penalize to some extent those who overtrade. So that is something we have thought about. But for tax, everyone's in a different scenario. So as yet we haven't. We may in the future, but not at the moment.
Just on that, do you, without going into personal cases, have you drawn any broad conclusions from your network yet? Like, is someone trading, does someone who trades frequently get a better result than someone who trades infrequently, for example?
There's always exceptions to the rule. So we're knocking on the door of about 14,000 users on the platform. So there's a bit of an infinite monkey theorem here. So, there's always going to be someone doing particularly well with a particular strategy. And we have people joining all the time. So there's people who might look brilliant for a few weeks and then fall away and vice versa. But I would say this is some general observations. I strongly believe this as a general rule on markets, but I think those who overtrade tend to underperform. And by the way, that's without those taxation and brokerage restrictions that we have. But definitely, I've noticed that. Another thing that is a very obvious feature to me, at least, is that you can trade your virtual portfolio on Strawman without saying anything. You don't have to put any notes up there. You don't have to put a valuation. But those that use the platform a bit like an investment diary, so they're not just buying X, Y, and Z because share price is moving up. They're buying it because they've looked at the business. They understand the different dynamics that are at play. You can tell when you see some of these guys that have been on there for a while. They put a lot of research into this. They've clearly done their homework, and lo and behold, they're the ones that tend to outperform longer term.
Question for you about the platform and what you're doing. It seems quite a wide-ranging platform, as you say, with 14,000 users. How are you funding it? I can't see any sort of obvious advertising or linkages there to brokers or something. How's it being funded?
Tony, it's 2020. Revenue is so last millennium.
Right. You put it on Afterpay, have you?
We put it on. So we make peanuts really. We do a few sponsored posts occasionally. We have some affiliate programs, if you like, of ShareSite, Australian Shareholders Association, these kinds of things. But we haven't really turned the revenue taps on yet. Frankly, we could, I think, in fact, we've had a lot of offers, but it tends to be from investor relation firms. And it tends to be investor relation firms that are being paid by, if I can be blunt, really crappy mining stocks that want to pump their prices. And these guys pay a lot of money to promote their stock. So it's been very hard to say no to that money, but we feel as though the moment we do that, we devalue the whole experience.
Right.
And frankly, it's that Charlie Munger idea of he whose bread I eat, his song I sing. And as soon as we do that, our allegiance will be with the investor relations company. It won't be with the investors. And we want to look after the investors. And the only reason we haven't, was a couple of reasons. We do have a revenue model. I'm happy to tell you about it, although it's very tentative and subject to change. But we haven't wanted to initiate that yet until we've got this positive flywheel happening. The challenge with social networks, and Google Plus found this out the hard way. It doesn't matter how good the technology is. If there's no one on your platform, it's worthless. Even if you've got and this is Google tried to beat Facebook with Google Plus, and it was a disaster. So we don't want to let anything get in the way until we've got a self-sustaining community there. So anything that was going to impede that, we weren't interested in. So we've just been funding it out of our own pockets through till now. And the other thing was trying to come up with a model that would enable people to participate to varying degrees. We want it to be free always, but we want to have a higher premium level of membership that gives you extra benefits and extra bells and whistles. Right. And so there's been a challenge in sort of designing that and building that. I'm really excited to say that I think we've got something that's really cool there. I want to keep my cards a bit close to my chest. We're hoping to. If you asked me at the start of the year, I would have said it was going to be out by July, but that's how things have gone. But we've got something that I think will be great in that it will be free if you want it to be free, but if you want to have a higher level or a better experience, there's something there as well, and one that will actually recognize and reward financially those that are the better contributors.
Right.
That'll be the electric Strawman.
Yes, that's
sign up for.
Absolutely, that's exactly right.
So I guess my line of questioning goes to this next question. If you're not making money out of advertising or subscribers or some other way like that, are you making money by setting up your own investment fund that uses some of the better returners to guide what you invest in, for example?
I wish we had. So we've got this thing called the Strawman Index, and what that does is it's hard to explain verbally, but in broad terms, what we do is we take the more popular stocks from across the community, and we build a sample portfolio based on that. And that thing, if you just go to Strawman and then hit the companies tab, you'll see how insanely good that thing has been. If I open it up now, in fact, so since we had a very early alpha release in late 2017, and then the public version was released in 2018. Since then, it's been 41% per annum versus 6% for the market. Even over the last 12 months, it's been about a 22% return versus a negative 2.6% return for the market. So I wish we had done that, because we would have made incredible returns. But I've been fortunate that all of my personal wealth is in the share market and has been for over 10 years. And that's permissioned me to fund Strawman and to avoid having to go cap in hand to any investor relations firm.
Yeah, I'm just scrolling down that list, and it's great returns. A lot of tech stocks on there and buy now pay later type stocks. I mean, congratulations, it's a great return. I think what would stop me from investing in that index is the worry that next month it all goes south, just like it did in 2000. So,
yeah,
and that seems to be the way that, I mean, they're fantastic returns from these users, and they're all based on those kinds of companies. And that seems to be the way that Strawman goes. Is there any sort of, I guess, divergence in the Strawman population that has a more traditional type investment theme to it? Or do you, is it overwhelmingly of one type of profile that tends to go after the buy now pay laters or tech stocks in their portfolios?
Yeah, Tony, it evolves. So we've sort of started off with a few hundred, and as it's grown, it has morphed. So it's hard to sort of pin it down to any one particular style. I would say if there was any particular bias, it was certainly towards smaller cap stocks. But that being said, I mean, some of the really big winners that we've had are certainly small cap stocks, but there's real businesses there. They're the businesses with sales, not necessarily profits in all cases, but real businesses executing to their strategy very, very well. But I guess the other thing I would say is this index was really, we put this in place inception before we knew how it was going to be. One, because we felt it sort of gave a lens into the viability, the quality of the community. But I don't think anyone would sort of say you should follow that to the letter. It's more of something to sort of keep us honest. Within that group, you've got people who would invest only in income stocks. Some people who only invest in property trusts. Others that vote, go for the buy now, pay laters and the pot stocks and lithium stocks and all of that. So everything in between. So the other thing that I would encourage you to do is go to that members tab there. You can look at the various leaderboards that we have and start scrolling through some of those top performers. The 1 month, 3 month leaderboards, it's a little bit of noise. There's a fair bit of luck involved in those kinds of timeframes. But those people who have been on the platform for over a year or so, you'll see some really great contributors and a real divergence in terms of approach.
Yeah, there's certainly
this is the idea as well, is that we don't want to. I've got very strong views, as anyone who's heard me speak before, on how I think you should approach the market. And there's certain approaches that I'm very anti. But at the same time, we didn't want to be too ideological. We really wanted to sort of let results speak for themselves, to sort of say, we're agnostic. You want to be a chartist, you want to be a momentum trader, you do what you do, and you do whatever you want. And if you know what you're doing, it will come out in the results. It'll come out in the wash, so to speak. So we're totally agnostic. And I would say anyone who's considering jumping on there, don't feel as though you have to conform to any one particular approach. You do what is appropriate to you. And before you follow anyone, certainly before you think about following any of their ideas in the real world, get to know them. You'll see, as I said, there's so much transparency here. You can click on a user profile. My profile is, I should have come up with a better name. My profile is Strawman as well. And you'll see the stocks I'm holding, and you'll see how often I trade. And you only have to flick around there for a few minutes, and you'll get a very good sense of the kind of investor I am, or in terms of the approach I take, a preference that I have. And I think that is, while the returns are what get the headlines, it's diving deeper into the actual activity of a user that will be very, very valuable for you in working out who is this person out there in cyberspace doing these trades.
Yes, I'm just looking at your portfolio now. Is this how you invest yourself outside of the platform in real, with real money on the ASX?
Yeah, it's not a perfect match because of tax considerations and the rest of it, but it's pretty close. Yeah, and so if there's a stock on my Strawman portfolio, I think without exception I hold it in real life. Maybe the weighting's a little bit different, and maybe the timing's a little bit different, but it's a pretty close analog.
A couple of things. Have you always invested that way? You said before you've been doing it for 10 years. So has being on Strawman changed you at all?
So I've been investing for about 20 years or so. It's only that I would argue I've only been doing it seriously for about 10 years, in the sense that like literally selling my house and putting every last cent I own into the market. I've been doing that for about 10 years. But yeah, when I started off, I was buying stuff because the share price was going up and it sounded cool.
Why did you sell your house and invest it in the market?
I felt as though I could get a better return.
So you didn't think of mortgaging the house and putting that in the market?
So no, I didn't. And that is a whole other story. We actually found ourselves on the 730 report earlier this year because what's the short version? So obviously when you do that, you need to rent. And I thought on paper renting made a great deal of sense. And it was all about how much you could make your capital work for you. And financially, it's worked brilliantly. There's no regrets. But what we didn't factor in was that when you rent, you have no security, and there's lifestyle factors that come into play that don't get reflected on a spreadsheet. So Tony, if I had a time machine, I should have done that, but I didn't do that.
Well, go out and buy a house and then sell your shares to buy the house, and then mortgage the house and buy the shares back.
There's definitely that as an option too. And a lot of this money also has been since tied up in Strawman, which is at a certain stage as well. So it's all part of it.
Sorry, that's not financial advice, by the way. That's general advice only.
Yeah. No, look, and I would never advocate for anyone to do that either. You got to do what's right for you. But that's what we did.
looking at your portfolio in Strawman, you're holding a lot of cash. Is there a reason for that?
Yeah, I wish I hadn't. It's been a huge drag. So I think partly it's of all the companies that I really like, I don't necessarily like the valuations that are out there. And there's only so much cash I've got, as in the real world on Strawman, there's only so much cash I've got to invest. So I've actually had a higher than, in hindsight, necessary weighting in cash, because I felt as though I would like some dry powder should some attractive opportunities come along. And I definitely took advantage of that in some way back in March, but not nearly as hard as I should have. So.
That's an interesting point. Cameron and I looked at setting up a QAV portfolio on Strawman when we were starting out. And the first question it asked was, what's the IV you place on this stock? And we both tried, and we both said, well, we don't, basically our portfolio is above the IV that we would calculate for the stocks, but it doesn't worry us. So why is there an emphasis on having an internal value, an IV calculation for a stock?
The very early version of Strawman, we forced you to have an IV. If you weren't prepared to say what you thought the share was worth, even broadly, we wouldn't let you place the trade.
That must have been when we were trying to start our portfolio. Yeah.
So that was, as I said, I did sort of start off more ideologically driven than I've since become. So you don't have to do that anymore. You don't have to do a valuation there. But I look, personally, as an investor, I think firstly, any intrinsic value calculation is wrong.
Yeah, I think so too.
It has to be wrong. Like, you can't predict the future. And even if we could perfectly predict the future, you might have a different desired rate of return and therefore use a different discount rate. So there's problems with that. And I'll acknowledge that. But I do think at the same time that you should have a general sense as to what is, broadly speaking, what is cheap, what is expensive.
Yeah.
You have to, right? I mean, by definition, if you're buying something, I would like to think it's because you think it's good value.
Correct.
Now how you estimate value, you may have come at it a different way to me, but if we were at a pub and you're trying to pitch me a stock and you could give me a great rundown of the business, that would be wonderful. But my next question would be Tony, why do you think this is good value? Now, I don't expect you to give me an answer to 5 decimal places. And I always laugh when you see the brokers say that, we value, X, Y, Z, and they give you this hyper precise. It's nonsense. And whenever I do a valuation, I probably have a dozen different valuations, and but I go for that generally right as opposed to specifically wrong. I think you have to have a notion of value. Otherwise, what else frames your buy-sell decisions?
If I was forced to use an IV or to convince you as to why a stock was value, I would use price to operating cash flow. And in our investing world, we look at stocks which have a price to cash flow of less than 5. And I expect that to go up in the future because it's something with a price to cash flow of less than 5 is pretty cheap. But whether it goes to 10 or whether it goes to 15 or whether it goes to 7, I've got no idea really.
Yeah.
So it's hard
But just you saying that already gives me a huge insight into you as an investor. And when you say you like a stock, I can frame that opinion around a particular philosophy or outlook. And so I find it's super valuable. And again, we could debate whether that's the best way, but the fact that you have a way says it speaks volumes to me.
Yeah, right. So let me go back to the index and the Strawman profiles and the leaderboard. If I wanted to use Strawman to construct a portfolio, if I went out, how should I do that? If I went out and bought what was on the index now, they may have already had their run. Do I wait until there's a trade on the index and something new comes in before I buy? What would you recommend?
I'd walk you back a bit. I would say, and we're always very careful with this, partly for licensing reasons, but also just for ethical reasons. I would never advocate to anyone just buy and sell whatever comes in or out of the index. It's a wonderful track record, but for a long-term investor like me, even the 3 years that it's been around for is an incredibly brief amount of time, and it's been achieved in a very bullish market overall, with a particular bent towards technology and growth stocks, which has, for whatever reason, been favored. So, I would not encourage you to do that. What I would encourage you to do would be to take that 100 grand and invest it as you, Tony, would invest it today in real life, if I gave you $100,000 in cash and you went out into the ASX, what stocks are you going to buy and why? Roughly, what do you think they're worth? Forget the index. The index is just going to aggregate you and Cameron and me and a million other people out there, and it gives you some perspective, but I wouldn't say just buy the index. In fact, if you bought the index and everyone bought the index, it would just feed on itself and it probably wouldn't work.
Correct. Yeah. No, it's interesting though. But so, how do I approach? How do I make money from Strawman as a new user to the network? Do I just follow someone who I like, who mirrors my investing style? And I'm talking about a user who comes in who doesn't have the time because they're a doctor, dentist, lawyer, or whatever to do their own research.
Yeah.
But they have the cash to invest. What should I do?
I think there's two ways to approach it, and they're not mutually exclusive. I think the first one is it's just a wonderful training ground. I mean, it's play money, so you can't lose anything here, but you can still invest in real stocks, real stock prices with virtual cash, and so it's going to just give you wonderful real world battle experience on the ground, but risk free. So I think for anyone who's particularly new to the market, I think get in there, get amongst it, buy some stocks, and you'll just gain experience without risking your real hard-earned cash. The second way I would do it is actually spend a bit of time investigating the people who are more active. When I say active, not necessarily in trades, but active on the platform and adding insight and research and stuff. You'll see these people. They're very prominent in the newsfeed. Our activity filters will show you sort of who's putting a lot of work in. The leaderboards will show you the people who have delivered very attractive returns over a long term. Have a look at the people that resonate with you. What are the kind of stocks they are buying? Is that align with your temperament and tastes? And then use it as an idea. But the thing is, and I'm really fond of saying this, I say it all the time, but you can borrow an idea, but you can't borrow someone's conviction. So we could all have a chat and I can give you a pitch and maybe I'm convincing in that pitch and you run out and buy it. But the second that thing drops 20% for whatever reason, if you don't know anything about it other than Andrew likes it, you're not going to be able to hold through those tough times. You're certainly not likely to buy more. But maybe you shouldn't be. And so really, this is an idea generator, I would argue, but it's on you what you do with it. And it actually frustrates me quite a lot if someone, it's not just us, it happened when I was at the Fool or anywhere else, is that someone would get a tip from somewhere, the internet, and then if it would go well, it was their own genius, and if it went bad, it was everyone's fault but their own. And that sounds really harsh, but I say that in all seriousness. This is your money, and no one cares more about your money than you, and no one is responsible for that money other than you. So don't jump onto Strawman and just buy something because someone who happens to be ranking well at the moment likes it. I mean, that is a really dumb thing to do. But pay attention to what they're doing. Dig a little bit deeper. Use it as a starting point for your own research. Build up your own investment thesis. Own the idea and build conviction. Because if you don't do that, the best ideas in the world are not going to help you.
Yeah, I mean, that's speaking from my personal point of view, that's one of the reasons why I haven't been actively involved in Strawman, because I find it difficult to find people that reflect my sort of investment methodology. And I couldn't have the conviction to invest in some of the high growth, high price stocks that are pushing people to the top of the leaderboards there. So yeah,
but I mean, I'm so glad to hear that, and you shouldn't, and I would never encourage you to. But you should be your true self. I suppose it will out. There are, as I said, if you look at the short-term leaderboards, that thing rotates all the time. There's yesterday's hero. Today's hero will be yesterday's hero in a month's time. I don't mean to be mean or rude to the people who are ranking well at present on those leaderboards. I wish them every long-term success. But again, you'll see over time those that stick around and those that roll with the punches and those that adapt. And there's no algorithm, unfortunately, that we can generate that's going to sort of emerge this for you. And even then, if it does, there's going to be all kinds. I mean, this is why back testing doesn't work, right? Like the future is we live in a very chaotic, hard to predict universe, impossible to predict universe. And tomorrow is not going to be like yesterday, even if it's very similar. So this is, I think, I just really want to make the point clearly here that this is not any kind of black box that you should just follow and buy. You know, this is for you to practice on. This is for you to join a peer group who are people who are selflessly sharing their ideas, putting themselves out there for all to see, with a track record to get rid of the noise, so you can have a sensible adult conversation with other serious investors. I mean, that's why on Strawman, if you look at Strawman, here's something that no one believes, but it's true. In the whole time that we've run this, I've probably moderated 5 posts. I've never had to, very rarely have I had to delete anything, because people who get on there and try to hype things, I mean, they just get voted down by the other users in the community. And all their shenanigans result in very poor portfolio returns for them anyway. So no one follows them. It's hard to pump and dump when there's a spotlight shining on you, and there's community endorsement and community ranking on there, which is I think that the best part about all of this kind of stuff.
Yeah, that was my next question. You've outlined a really good thesis for the positive side of Strawman, but there must be a negative side as well. And from personal experience with other forums and other companies that do this, yeah, pump and dumps, people buying a stock and then touting it as the next best thing is, I mean, there's a dark side to these kinds of platforms often. I'm not saying there is with Strawman, but how do you, I guess, apart from what you just said about the rankings, how do you try and prevent the touters and negative comments and even shorters from unleashing mayhem on a platform like Strawman?
Yeah, so I'll go back a step. So when we got VC funding last year, and we speak to a few, which was really nice. They ring us up and they want to know more about the business. And one of the things that you always get asked by these investors is, what is the problem that you're trying to solve here? I mean, forums exist, you know, so what's new about this? And I guess the problem that we're trying to solve is that exact problem of actors that have ulterior motives, which anyone who's been to said forum that's out there knows that is a huge problem. That's the problem that we're trying to solve. And we do it by, one, making people accountable. So and people aren't dumb. We've got a really strong community. So if I get on there, I'm saying, buy this, and I joined up, you can see when they joined up a week ago. They've relentlessly pumped this thing. They've put a high price. They've got no track record there whatsoever. Everyone who's looked at their post has voted it down by the established members of the community. They get no love. They get no traction, and they take their toys and they go home very, very quickly. So even on our company page, every company, rather than having 50,000 threads for every company, we have a company page. And if you go click on any company in Strawman, you'll be taken there. We'll give you the consensus forecast from the community. And then we've got what we call straws, which are kind of like tweets. It's a concise viewpoint or perspective on a company. It's not a conversational thing like a forum. It's actually meant to be a specific insight or perspective on a business. But they're ranked, and there's algorithms there that date them and rank them according to how new they are, how many people like them. And I'm really excited about this. We haven't released it yet, but we're getting much more sophisticated on that. So when someone who's been on the platform for a year, who has a really good performance and lots of followers votes, that will have much more say than the bloke who joins up yesterday. It has no performance. So we're trying to sort of algorithmically account for that. Much like if there was a whole bunch of us around a kitchen table as an investment club, and we've been doing this for 10 years. We all know each other very well. We know what Cameron's like. I know what Tony's like. I know your style. I know your track record. And then we invite someone new into the club, and they sit down at the table and start mouthing off about the latest and greatest thing. Now, our opinion is going to count for a lot more, and it should, because we're a known quantity, even if we don't have, in every case, the best performance. And so we're trying to sort of bring that common sense approach to evaluating perspectives to the platform. And you can do it in very clever mathematical ways. And it started out very basically. It's still got a long way to run. Just as Twitter and Reddit and these things are always adapting their algorithms, we are too. but we're trying to do it in that way. So there is a peer review that is in place here. There is community endorsement on content. So we can't stop, and we don't want to stop anyone from getting on there and saying whatever it is they think, even if what they think is rubbish, and they're not acting in the spirit, in the way that we would like them to. But members can sniff this a mile away. They will act appropriately, and that content will be weighted appropriately.
Has anyone on your site ever recommended Apollo Tourism and Leisure, Andrew? It's something we need to know.
What's the ASX code?
It was an APT Afterpay. I always get it confused with Afterpay. Something like that. Don't worry about it. You don't want it's an in joke.
ATL, I can see.
ATL, yeah.
Well, see, this is the thing. I can look it up. I can tell you that 8 people have it in their portfolio. 19 people are following it. It is exactly on the consensus valuation at this stage, but no one has added any straws. So it doesn't look like it has much love on the platform at this stage.
Yeah, I wonder why. It's a long story. Sorry, Tony, I didn't mean to interrupt you.
No, that's all right. I guess getting back to your answer, Andrew, about the way that you're going to rank people who come onto the platform and try and pump and dump, for example, is the risk there that you could create some kind of groupthink where the people who've been there longest or loudest or have a particular style of investing dominate the conversation?
Yeah, definitely. And that is where the refinement comes into it. So we try things occasionally and we realize that is one of the problems. So it's all part of the refinement. I mean, one thing that comes into it is your performance and the longevity. So you might be diametrically opposed to everyone, but if you've been doing your own thing on Strawman for a few months and you've built up a good track record there, I mean, that will give you some weight to what you say. But the thing is I'll come back to the very initial premise of it's called Strawman. I mean, we want ideas to be challenged. The best way to improve an investment idea is to challenge an investment idea. And so, and it happens all the time, stuff I put out there, you know, people will come, I'll hashtag bull case and I'll write out why I like a company and someone will write a bear case. And it's the best thing in the world. And we don't want to discourage that in any way, shape or form. In fact, I vote up on a lot of straws that come through the platform that I totally disagree with, but I really value the content. And so and I'm pretty sure most of the established players do that as well, because it's not about sort of saying, I think you're right, I think you're wrong. It's about saying, I think this is a valid opinion and I think it adds to the tenor of the conversation and to the value of the debate.
Very good. I'm out of questions. Cam, do you have anything to add?
Yeah, I do. But before I get into it, Andrew, when you get a little bit excited, your microphone is whacking your collar there.
Sorry.
So if you can just try not to bob your head around.
Sorry.
Too much.
No, I really should get a proper mic. It's ridiculous.
So I wanted to ask you about your investment philosophy. Looking at your page here, you've had really good performance on your Strawman portfolio. Looking at a lot of the stocks that you hold, there's stocks that probably wouldn't pass muster for us. I'm interested in what's your process for determining what you're going to buy?
Well, as I said, it's morphed over the years, but I would say in recent years, I've been very much a growth-focused investor, growth at reasonable price. I think all sensible investing is value investing, but I like companies that have got a wind at their back and that are growing their earnings. I'm not too big into picking up pennies in front of steamrollers these days, although I used to do that a lot. But it's really basic. You know, do I understand the business? If I can't have a half intelligent conversation with the CEO, I shouldn't be buying that stock, no matter how attractive it looks on various metrics and the rest of it. I mean, how do they make money? Are they making money? How do they plan to make money? What's their available market? What's their competitors like? Forget the share market. I don't care what the prices are doing. I don't care about anything else. I need to have to come back to the cafe analogy, I mean, I understand what a cafe is. I understand how it makes money. I understand what is important, and I need to be able to understand that for a business. So there's a lot of really cool businesses that have actually done incredibly well, but I've not gone anywhere near because I don't feel as though I've got a good handle on the industry dynamics and the business model. Afterpay's in that category for me, frankly. I mean, I get it. I know what they do, and I could explain to you what they do, but that is a very fast-moving space where there are all kinds of structural changes within that industry that I just don't have a confident view on. And I think the bulls and bears might make a good argument. So I'm very happy to put things in the too hard basket if I don't feel as though I've got a high conviction on what the likely future is for that business, just broadly speaking. So I think that's the first hurdle. Once I feel as though I understand the business pretty well, I then need to have some kind of view as to, I have to quantify that earnings growth or that free cash flow growth or that sales growth. It has to come back to the financials at some point. So I need to try and be able to, as I said, very vaguely, generally right as opposed to specifically wrong, but I need to be able to sort of look into a crystal ball and say that I think integrated research is the kind of business that can grow its earnings at a high single-digit rate over the next 5 to 10 years. Or I think this business is likely going to plateau or is going to match inflation. But I need to have a view on that. And then I'm very big at looking at what can go wrong. So what are the things that I need to look out for? What's the balance sheet like? Is it in good shape? I can't predict macro factors, and I have no time to even try and predict it. That's not to say that you shouldn't, but that's just a limitation of mine. I got no idea what those things are going to do, so I don't try and do it. But I'd like to think that if we do have a bad recession, or interest rates go up, or FX rates change, that the companies that I hold, although may be impacted by those, aren't going to be completely derailed by those kinds of things. Do I trust management? Do management have skin in the game? And is it trading at a sensible price? And I think if I get all of those things right, I'll make an investment. And I try and, at a portfolio level, weight according to a combination of conviction, quality, and value. So the higher the conviction, the higher the quality, and the better the value, the more I will put into a stock. And I have no problem holding 15 to 20% of my portfolio in a single stock if all of those things line up correct. But and then frankly, from there, I feel as though I should be extremely fussy. There's thousands of stocks out there. I think that really, when you get to 15 or 20, you've got all the benefits you're going to get from diversification. So I treat my portfolio like a sport team. There's a lot of great companies that I don't hold, not because they're awful, but because I just don't think they're as good as what I've got. And so I try to keep it pretty tight. And then other than that, the last thing is I look to hold for I'm like Warren Buffett. I never want to sell. Why would I end a relationship, a beautiful relationship that is continuing to flourish? The only time I will sell is if the thesis is broken or the valuation just no longer makes sense. Other than that, I'm a holder.
Quick question, Andrew, on valuation. We've had this discussion with other people we've interviewed, especially growth investors. How do you go about valuing a stock that may not even be profitable at the moment?
Yeah, it's hard. Well, it depends. So if it's a pre-profit kind of company, I think you can get a lot of insight by just starting with top line growth. And again, generally right as opposed to specifically wrong. Not is it going to grow at 17.3% CAGR for 4 years, but what kind of general rate of growth are we looking at? What are the typical net margins or operating margins for a business in that sector? I mean, am I relying on this thing throwing out a 20% net margin in 10 years? Or is it more likely to be a 5% net margin? I need to have a handle on that, and I need to be able to argue what's reasonable. And then I need to figure out what's a reasonable multiple for that company, whether I'm doing a price to sales, price to cash flow, price to earnings. What is reasonable based on the historical experience, based on what peers are doing, and all the rest of it. And you fold all that together and you can get a target price that might be about 5 years out. And then I just discount that back by my desired rate of return. And the higher the risks involved, the more I will discount that back. And And then I will stress test that using a variety of assumptions and try and figure out a price that sort of, what's an average price based on that agglomeration of different views. And, that's why it's nice that it's that Ben Graham margin of safety philosophy, which I'm just huge on. All of these are guesses. Like, people in our industry like to call them forecasts, which sounds really sophisticated, but they're all total guesses. But I like to be very conservative in my guesses. And then I like to add a really big fat margin of safety on that. So even if I'm wrong, and I'm probably going to be wrong, that I've got far more upside than downside. I'm looking for asymmetry here, where if things go right, there's a lot of upside. But if they don't go my way, then the downside is limited. And frankly, I expect that it's the whole Peter Lynch, if you're right 6 times out of 10, you're good in this game. I expect to be wrong a lot of the time. But hopefully if I'm doing it right, so far so good. When you get it right, the gains more than make up for the losers. You cut the ones that aren't working well, and you continue to invest in the ones that are doing well. I'm a big fan of averaging up, by the way, too. Is if a company continues to execute really well, and my conviction continues to go up, I'm more than happy to add to that at a much higher price than when I initially bought in.
I saw a video that I think was the RASK conference from last year, and you opened up by talking about ETFs and how you recommend ETFs to friends and family, particularly if they're not willing or ready to, be a serious investor and invest a lot of time and effort into it, which is something common with what Tony has said on the show over the last couple of years. He believes that ETFs are a great place. He talks about the investing ladder, and an ETF is sort of one of the bottom rungs on the ladder as you're working your way up. But you mentioned the rate of return that you're looking for when you're doing your DCF, and I was wondering what you think is a good rate of return to get, because one of the things I've learned from Tony over the last couple of years is that as an investor, well, certainly with Tony's model, we're just chasing that 15 to 20% compound growth on average every year, not trying to get 100%. We're 15 to 20% with relatively low risk, relatively low effort. I don't have to spend 12 hours a day reading annual reports like Warren Buffett does. What do you think is a good, what are you trying to achieve with your portfolio, your real money, not your Strawman fake money, your real money? What do you think is realistic based on your 20 years of investing?
I think 10% is realistic, frankly. I feel as though it's a pride before fall moment. I'm really mindful of hubris, but it's actually been much higher than that. But I think let's go back 100 years with the US or any of the major Western industrialized economies. That's about what markets do with capital gains and income. And given that I can get about that, I mean, we could debate endlessly what the next 5 to 10 years is going to bring. Probably going to be less than that, but who knows? But long term, if I can get anywhere near that, the power of compounding is so phenomenal that I'm going to do really well over time. And if I can get that by doing no thinking whatsoever, just by buying an ETF, well, if I'm going to put all this effort into it, either A, I just have to love it for the sake of it, and fortunately I do. But also I need to compensate for my time and effort and anxiety and all of that kind of stuff. So I would say if you're putting in a lot of effort and you're not getting more than 3, 4, 5% above your benchmark, then there's probably better things you can do with your time. And by the way, it doesn't sound like if you can target 10% and you can get 12% per annum over the next 20 years, that is such a phenomenal difference in dollar terms. So it's very material, but you need to be getting some outperformance to justify what it is that you're doing. And sometimes you'll have, I think what people misunderstand about that is they think that if I can target 10% a year, that'll be great, and they're right. But that means I get 10% each and every year. I mean, no one gets that. Buffett doesn't get that. No one gets that. what will happen is that one year you'll get 60%, and then the next year you'll get minus 20%, and then you'll get 3%, and then you'll get 8%, and then you'll get minus 40%. And there's a lot of noise that is hidden in that average. And so people, the worst thing I think that can happen to you as an investor is that the first few years you just absolutely knock it out of the park, because it sets ridiculous expectations. And conversely, you can do very, very sensible things and get a very ordinary or even a very disappointing return over the first few years, and it just dissuades people from doing it. But it's about process, it's about consistency. And if you do that and you can generate that as an average, not getting 10% every year, but averaging that 10% every year, I think you should be pretty happy. And if you can get 15 to 20%, by all means, by all means.
What's the just to wrap up? What's the number one thing you've learned out of the Strawman experiment so far?
As an investor or as a entrepreneur?
Well, both, if you want. Yeah.
So, as building a business, I completely misunderstood the complexity and difficulty in the technical challenge. I kind of thought, how hard can it be? We'll get some people in, they'll build it, we'll go on, and then we'll run the business. Where in reality, the technical development never stops. The reality is that someone who might be a $400 an hour developer is much, much cheaper than someone in the Philippines who's charging you $10 an hour. Because although on an hourly rate, it's much cheaper, they'll probably make a big mess of things, and you're going to have to fix it up, and they'll take 10 times as long. And so, you know, there's a lot of blogs and podcasts that talk about startups and that, and they all say, oh, make sure you get good people. And I nodded, and everyone nods. Make sure you get good people, because they are everything. And we have had some horror stories of some of the people that we've had, because I was a tight ass and I based my judgment on an ignorance of what was important, and by looking at things on an hourly rate basis, which was a mistake, which we finally addressed, by the way. I've got some really great developers now. But that set us back years and literally cost me tens of thousands of dollars, if not more. So there's a big lessons in all of that.
Same with marketing consultants, like Electric Bean versus Strawman. Like
Never gonna...
you wanna pay for the good brand consultants.
I'm straight after this. I'm taking this down from the LinkedIn.
Don't do that. It's great. Where you came from. It's a good story.
Yeah, I mean, it is so true in so many different aspects, whether it is marketing, and that's the joke in marketing, right? I mean, every marketer knows that half their budget is wasted. They just don't know which half, right? And I think there's a lot of parallels with that. So a lot of lessons learned there. If I was to start again with this thing, I reckon we could get to where we are now in about 6 months, and we'd have, technically, from an infrastructure and architecture perspective, we'd have something that was 1,000,000 times better. So you live and you learn. From an investment perspective, I guess it's not so much a learning but a reinforcement, which is really pay attention to those that disagree with you. I mean, seek out contradictory opinion and take it seriously. I think that for every one of the stocks that I hold, I'll give you the bull case and I'll explain to you why I'm holding it. But if I can't articulate the bear case better than the most bearish person out there, then I shouldn't be holding that stock. Doesn't mean I need to agree with it, but I really pay attention to those that post differing views to me on Strawman. And I think that's a lesson that's been really reiterated and reinforced. And it's a very hard thing to do emotionally and psychologically, because, as I said, we want that confirmation bias. And you look at Twitter, right? Like, we all surround ourselves in this bubble, you know, of all the people that we agree with, because it's more comfortable. But I really try and follow people on a lot of social platforms that I fundamentally disagree with on a lot of areas, just to try and avoid that. And I think that is something that as investors, we should all try and do a bit more of.
Yeah, no, I agree. I think as humans, we should do that. It's incredibly important to have our ideas challenged and put ourselves in situations where they will be challenged by smart and articulate people.
Yeah.
Good stuff. Well, last question. We always ask guests to give us a book recommendation, either from an investing perspective or not. Just what are you reading? What can you recommend as a good read?
I just finished, just this morning, I finished reading a book called Homo Deus by Yuval Noah Harari. He's
Great
more
book.
famous for Sapiens.
Mhm.
And Sapiens is an incredible book. And I've just purchased Lessons for the 21st Century, which is his other book. It's a brief history of the future. It's pretty bleak. And it's a very mind-blowing kind of book. And I think what it highlighted for me is that we are living in such a unique point in history, and the future is going to be either unbelievably brilliant or unbelievably terrible. It's probably my takeaway from it, is we're going to bifurcate.
What else is new?
Yeah, well, it's different. I mean, if you lived in the Middle Ages, your great-great-grandchildren probably had the same lifestyle and same world as you did. But, even I was born in 1975, and, my lifestyle as a kid is very different to what my kids, and I dare say my grandkids will be, if they're not all chipped up with Neuralink brain devices or something at that point. So it's just a fascinating point. And I think it's interesting as a human, but I think there's a lot of lessons for investors as well.
I was having a conversation with one of my 20-year-olds on the weekend. He came over and he was he was depressed. He's sad and he's frustrated and he's angry. And I said, what's going on? He goes, my TikTok numbers just have stagnated for the last couple of months. It's not growing. I said, wow, yeah, that's a really tough problem. I said, let me show you something. I grabbed a photo off my hard drive of my mother when she was, I think, about 2 in Bundaberg, like this little wooden shack they lived in, a truck that they were driving around in, which was no more than an engine with a steering wheel jammed into the top of it and like a plank of wood on the back. And, I know she told me she didn't have electricity till she was 4 in the house. And I'm like, your biggest problem is that your funny videos that you're making aren't growing. You've only got hundreds of thousands of people and not the millions you thought you'd have by now watching your videos. Really, that's
first world problem.
Yeah.
Did he take the photo and post it on TikTok?
No, he didn't. But he did make me do a TikTok with him where I took my shirt off. So
I saw that. I can't unsee it.
Yeah.
I feel like
you're
one
welcome.
of those people on Facebook who have to look at beheadings and mass murder to put them down.
You're lucky I didn't charge you to see the glory of my dad bod, Tony. Well, Andrew, thanks very much. Really appreciate you coming on and having a chat. That was fascinating. And I'll jump back into Strawman and spend a bit more time in there now that I understand a little bit more about it. Thanks, mate.
I really enjoyed it, guys. Really,
Me too.
A real
And
great pleasure.
Good luck for the future too. It's an exciting future I think you have.
Thank you very much. Thank you.